Good afternoon, everyone. My name is Errol Zeki, and I'm the Chief Executive Officer at Sasfin Wealth. So on behalf of Philip Bradford, my colleagues from the Somerset West office, Sasfin's Somerset West office, and myself, I would like to welcome you to this live webinar. It really has been a roller coaster ride on local and international markets this year. I think amazingly, as of last night, the S&P 500 index in the US is down only about 1.6% year to date, and the all-share index down about 4%. But if one starts to really break this down, however, globally and locally, it paints a very different picture. So, I mean, the recovery in the US has really been dominated by large tech plays, and locally, what is commonly referred to as SA Inc., so your property counters, general retailers, financials, etc., paint a very different picture. Most of those are well down from their pre-COVID levels. Much of this price action, internationally and locally, has been very much influenced by fairly aggressive and accommodative fiscal and monetary policy, and this includes very aggressive interest rate cuts. So today's webinar is going to be focusing on income alternatives in a low interest rate environment. So during the presentation, please post any questions to the chat functionality. We will identify and combine the most common questions and respond to as many of them as we can after the formal part of the session. But that's enough from me. Presenting today is Phil Bradford. He is the Chief Investment Officer at Sasfin Asset Managers. And he's the fund manager of our flagship income and global multi-asset class funds, including the multiple award-winning Sasfin BCI Flexible Income Fund and the Sasfin BCI Balance Fund. Phil started his career at Investec in '99, where he worked for 9 years in asset management, mostly in bonds and as an interest rate trader. Prior to joining Sasfin in 2014, he spent 6 years at Absa Wealth in the role of Chief Investment Officer. He is a CFA charter holder, a member of the JSE, or rather the FTSE JSE Advisory Committee, and a past president of the CFA South Africa Society, or Society in South Africa. So thank you very much, Phil, and over to you.
Thanks very much. Okay, well, thanks everyone today for joining us. I've been asked to talk about, I suppose, investing what I call in a low interest rate world, and really what we're looking at the moment is a world that has changed dramatically in the last few months. But many of these trends had actually been in place for many years, and to any extent generations. Some of the trends that we're getting to are a low interest rate world, and this makes it very different for us as investors when we are investing in a low interest rate world. Just very briefly around Sasfin Asset Managers, Errol gave us a brief introduction. I'm going to be talking predominantly about some of the cash alternatives and income type funds that we manage. And really these are going to give investors that are either invested in equities or invested in cash, alternatives that they can actually have a look at and still try and get decent returns in this low interest rate world. And we've won a number of awards for these funds over the last few years. Just briefly about Sasfin as well. For those of you who don't know Sasfin very well, we've, as a business, it's been around for many years, from the stockbroking and asset management side of the business even longer. And our broader investment team has over a small amount of people actually has over 250 years experience in the financial markets. Across the board, we have a range of funds, right from our optimal income fund, which I'm going to talk about today. Our flexible income, which is optimal income, is a tax efficient cash alternative where you get we try and target a sort of a better return after tax than you would get in cash. And we've done that very successfully over time. I'm going to talk about our flexible income fund as well, where I look to invest in more taxable instruments like bonds and cash, etc., but where we've been able to generate very good returns over time. And this is just briefly some on the performance. So firstly, I'd like to ask the audience, where would you rather like to live? Is it in London, rainy, wet London? Is it in Canada, icy, cold Toronto? Is it Australia? Or is it beautiful, sunny South Africa? And for those of you, obviously, I should probably put up a picture of Somerset West, rather, which is arguably a much better place even to live in than central Cape Town. And the answer to this is very simple for all of us who actually live in South Africa, is we know that the return that we get from living in South Africa is greater than the return we get from living in other countries. Our quality of life, our utility, our bang for buck, the yield effectively that we get for living in South Africa is significantly higher. If we had to emigrate or move to one of the other countries, our money doesn't take us very far. The return on our money, it doesn't take us nearly as far. Even from myself, who lived in Cape Town for a number of years, moving back to Johannesburg, I get a fantastic return by living in Johannesburg. I've got a bigger garden, I've got space, we've got great sunshine. Even in the middle of winter, we have good weather. And for us as people who live in South Africa, and we understand this. And my point today is that from an investment perspective, if we compare what is available to investing in South Africa, our bonds and our interest rates are our big competitive advantage. And it is something very similar to the utility we get out of living in South Africa. Yes, there are more risks, but the return that we get is exponentially more than what we would get by moving off to another developed market country where we wouldn't be able to get that same sort of return. So with interest rates now at incredible lows, all-time lows essentially, most of places around the world, the US is even higher than a lot of places in Europe. In many countries, interest rates are negative. A country like Switzerland, for example, for many years now, if you pay your taxes early, they actually penalize you because interest rates are negative and they don't want to earn the cash type return. So for us in South Africa, up until very recently, cash was a fantastic return for us in South Africa. But now going forward, that story has changed a bit. And this is what we're dealing with in South Africa at the moment. If you can look at the slide here, you'll see the red line are the interest rates available in South Africa. And these are from 3-month interest rates to 6-month interest rates to 1 year, right the way out to 30 years. And if you had to go to a bank and ask for a fixed deposit, these are the kinds of returns that you would probably get. You would probably get a little bit lower, but these are effectively what we call the bond yield curve. So on any given day, we know what the interest rates are and what the forward returns are going to be from bonds and interest rates and effectively fixed deposits in South Africa. And if you compare this gap between a 30-year bond in South Africa or a 30-year fixed deposit in South Africa right now, and the equivalent in America or in Europe, you'll see that it's typically actually today over 10%. Now that 10% gap is significantly higher than it's been over time. And normally this gap would compensate you for the depreciation of the currency over time. And over the last 35 odd years, despite where we are at the moment, the Rand's only depreciated about 5% a year. So about 35 years ago, we were at about 2 to the dollar. And now where we are today, that depreciation, even though it seems massive, has only been about 5% a year. But the interest rate differential is about 10%. Now, what that really means is even if the Rand continues from these weak levels to depreciate at 5% a year, a foreign investor can come in and get 10% in South Africa, take the depreciation, and still make a 5% positive return. So what a lot of them actually do is they go and borrow in America or in Europe, and then they come and invest into a high-yielding country like South Africa. And that is called the carry trade. You borrow cash, you carry it across, and you earn the differential. So what we've got at the moment is it's not so much the shorter dated cash yields, which now cash in the bank on institutional money, even if I go shopping with billions of rands, I can only get about 3.6%, 3.5% from a bank on a call account, where on the longer dated basis, I can get much, much higher returns than that. And this is not how it used to be. You know, I got involved in the bond market in the early 2000s, and in those days, cash rates used to be a lot higher than your longer dated rates. Even if you go back to 2006, 2007, I could get about 12% out of a 1-year cash rate, where the bonds, the 10-year bond, which is like a 10-year fixed deposit, was only giving me 7 to 8%, where now it's the other way around. And what this also is, with inflation at around 3% at the moment, it means that the longer dated interest rates in South Africa are actually allowing you to lock in a overinflation plus 8.5 of current inflation at the moment. Now, what we've seen, and South Africa's obviously in a certain amount of trouble at the moment from an economic and a fiscal perspective. We all understand this. But this shows you what happened when Brazil was in similar trouble not too long before Nenegate at the start of 2015. Ourselves, Brazil, Russia, Turkey, etc., were all in quite a bit of trouble. And what happened is, this is the yield on Brazil's 10-year bond. And you can see it shot up from at the start, well, just at the end of 2014, from around 10.5%, it shot up to just under 17%. And then the rating agencies downgraded Brazil. And by the time Moody's downgraded them, the improvements started happening massively. And what we see now is that Brazil's 10-year bond is currently sitting at around 6.5%, which is about 3% below South Africa's 10-year bond. So Brazil, which is one notch below us into junk, their 10-year bond rates are about 6.5%, where ours, as I'll show you in a moment, are about 3% above that. The same story happened with Russia, that once they got downgraded to junk, the improvement started and things started improving. The same thing happened with Hungary, the same thing happened with Greece, almost without exception, out of decent investment grade emerging markets like South Africa, we've seen big improvements after they got downgraded to junk. And the main reason for it is, what happens is, when you get downgraded to junk, you typically fire your president. You start putting commissions of inquiry in place into corruption and trying to root out corruption, and you start trying to put fiscal and spending restraints in place and start trying to fix up your economy. And that is exactly what we're actually seeing right now with South Africa. So you can see with South Africa on this slide here that we were borrowing, in fact, if you go back into 2014, we were borrowing at about 6.5% on our 10-year bonds. Just at the start of 2015, it was 7%. Nethergate was here, which was the biggest sell-off we'd ever had at that time in our bonds. And then S&P and Fitch came and downgraded us. So the market actually overreacted before the downgrades happened. And then we see the coronavirus sell-off here. And the bonds shot up, the bond yield shot up massively. And then Moody's came to downgrade us to junk. And after that, similar to what we've seen virtually every time with countries like this, is our 10-year fixed deposit rate effectively at the moment is around 9.5, closer to 10 today, actually. So what we're seeing from this really is that normally the market tends to factor in the bad news way in advance, and the bond market is known as the smart market. Now, if we look at it in the past, we could expect inflation over the last 35 years was around 7.8%. Cash gave you just under 3% more than that. So cash rates over the last 35 years, you've got over 10.5% out of cash. Now, what we know, of course, is that that's changed right now. Over that same period of time, bonds in South Africa, which are basically like longer dated fixed deposits, and those are almost entirely government bonds, gave you around just under 12.5%, which was about just over 5% more than inflation. Global bonds, with the depreciation of the rand, so with the benefit of extra depreciation, if you had bought global bonds, you would have actually done marginally worse than local bonds. And it's very simple, because local bonds had a much higher interest rates, as I've already said, in South Africa. Property, global equity, and domestic equity did much, much better, because in the 80s and the 90s, and then in the first part of the 2000s in particular for South Africa, we had exceptionally good equity returns. And this is to the end of March, when equity markets actually had done very, very badly. So this includes a 50% drop in property, and it isn't showing yet the recovery we've seen in global and domestic equities. But importantly, the global equities, even with the depreciation of the rand, actually underperformed local equities. But what this means, of course, is that we had this great risk-return scenario where cash gave you quite a good return, bonds gave you a better return, and then the more risky assets like the stock market gave you an even better return. The problem we've got going forward is that, and this was what I was seeing at the start of the year, was our outlook. The outlook from all the other asset managers in South Africa was for about 7% from cash, about 9% from bonds, and about 11.5%, 12% from domestic equities and properties. And they thought global equities would give you about 10.5% with the rand appreciation over the next 5 years. And they thought global bonds would give you about 6%. In other words, 1% in yield plus 5% appreciation. The problem is that I was a lot more negative, and our team were a lot more negative around what we were expecting from global equities at all-time highs, as well as domestic equities. And mainly because we'd already started to see the global economy slowing down before coronavirus. And we were, at the time, able to buy a lot of our bonds and shorter dated bonds, corporate bonds, as well as some of the government bonds at around 11%. And it made a huge amount of sense for us to buy the lower risk assets like the bonds rather than the high risk assets. And then, of course, what happened is coronavirus came along and the bond yields shot up to this sort of level. Cash yields have collapsed, and the forward view for cash from here, I wouldn't be expecting anywhere. You'll be lucky to get 4% out of cash over the next 5 years. The bonds are going to continue to give you now over 11%. In the longer dated bonds, and some of the other bonds a bit less than that. Equities and property and global equities obviously collapsed and have recovered. But the challenge we've got right now is, if you look at US equities, they're at extreme valuations because they factored in a lot of the recovery. And on about 33 times forward earnings, the S&P 500, the last 2 times it was at these sort of valuations was 2001 and 1929. And after that, your forward returns for the next 10 years were not very good, as we all know. So I'm not very positive on the long-term returns for equities from here, simply because I don't think they've factored as much of the bad news in as they could have. But most importantly, the bonds giving us inflation plus 8.5 are still factoring all the bad news. So what we're seeing at the moment is this interesting situation where, for those of you who've studied investments, they talk about an efficient frontier. And really what that means is, as I showed earlier, your low-risk investments should give you a lower return and your high-risk investments should give you a higher return. But the way things have set up in South Africa at the moment, our bond investments, which are relatively low-risk investments, are set up guaranteed effectively to lock in fixed rates of over 11% in the longer-dated bonds for the next 20 to 28 years. And really, it makes it, for me as an investor, it means that it's almost like the favorite in the horse race, instead of going at 1-1, is going at 10-1. And the outsider, which normally goes at 51, is going at 9-1 or 10-1 as well. And if the favorite in the horse race is giving you 10-1 and the outsider is giving you worse odds, you'd be crazy to not bet on the favorite. So I want to briefly just touch on what bonds are. Mainly because I think a lot of investors, equities are, and the stock market is the exciting place to be. And investors really understand what stock market is, because every time you turn on the radio, you'll hear about the latest company earnings, and the CEO of the company will be talking, and it's an exciting place to be. It's almost like I joke a bit like legalized gambling in some respects, but the good news is it tends to be in your favor. It's a bit like owning the casino when you buy equities. But equities are very volatile, and bonds are the opposite of that. And normally, I wanted to just give a brief explanation of what we're dealing with when we talk about a bond. Most people in South Africa at some point or another have had a bond. They've had a housing bond, and a bond is a loan. You take out a bond from a bank, they loan you money, and you pay back interest on that. In our instance here, we are the lenders when we buy a bond. We lend our money to companies, to banks, to the government, etc. And that bond, the only difference between that and a fixed deposit is that I can trade that bond in and out if and when we need to. Where a fixed deposit, obviously, you're locked in for a period of time. So we lend money effectively to companies, to banks, to the municipalities, to governments, etc. And what we don't do is we don't take any capital risk from the capital can be volatile, but with these essentially guaranteed instruments. So a bond usually pays a fixed rate of interest, predominantly fixed rates in South Africa, although we do have a lot of corporate bonds that play a variable rate of interest that goes up and down with the prevailing interest rates, which I'll show you in a moment. But it's, again, as I've mentioned a few times, it's similar to a fixed deposit. Now, both the capital and the income of a bond is guaranteed. So like when you take out a 5-year fixed deposit with a bank, you know that your interest is guaranteed and your capital is guaranteed. As long as that bank stays solvent and can pay you back your money, then you'll get your money back. And there's over 1,800 bonds on the JSE. So it's very much a market that is used by institutional investors like myself. I manage a lot of pension fund type assets as well. And the bonds it's not something that the average investor goes and buys, because you normally need at least R1 million to go and buy one of the bonds on the JSE. And that's just for one bond. And they work very different to equities because they're much lower risk, as I'll show you in a moment. So let me just give you an example. Here's Standard Bank. At the moment, I can get on a 1-year fixed deposit from one of the institutional banks about 4.5%. I know that I'm not going to get any capital growth, and I know that it matures in 1 year and my capital is guaranteed. Same on a 2-year bond, I can get about 5.5%, and then on a 6-year bond, I can get just under 7.5%. And those rates move around on a daily basis. If I go and buy Standard Bank shares today, the shares actually never mature. So I never know what I'm going to get. When I need to sell those shares one day, I don't know what that value will be. And it never actually matures. It continues in perpetuity. The income of a share are the dividends. And those dividends obviously change from year to year. And like we're seeing at the moment, it's actually uncertain as to whether we'll get dividends from some of our banks or some of our property companies in South Africa, or some companies that are under stress. But typically over time, a good bank like a Standard Bank has paid good dividends. And you do see some capital growth if the profits grow, but you also have got no guarantee of that. And of course, you don't know what your final value will be. Now, if a Standard Bank had to go bankrupt, who gets their money back? And this is a big if, by the way, because our banks in South Africa are very well capitalized. First of all, depositors will get your money back first. There's normally depositor insurance, and the smaller depositors, and then up to a certain point, typically get all their capital back. They're the first ones, if something goes wrong, to get their money back. Secondly, the bondholders come along. And there's different qualities of bonds and different sort of a pecking order, but effectively the bondholders usually get all their money back, if not most of it, the large majority of it. Thirdly, then comes along are the equity holders, the shareholders like preference shareholders and equity holders, and they typically lose all their money. So to give you an extreme example, the African Bank, when that collapsed, the bondholders took a bit of a knock at the time, but they've actually been now getting all of their money back. So over time, the bondholders are not going to have lost any money. In fact, they would have got interest on their interest. But the shareholders effectively lost almost everything. They lost over 95% of their money, as did the preference shareholders, which lost over 55% of their money. So a bond, really, the thing to take out from here is a much more conservative investment than buying shares, as you can see with the likes of a Standard Bank. But it's a very much a lower risk investment. Now, a bond is, as I said, like a fixed deposit. The value goes up and the value will go down on a day-to-day basis for this simple reason. If you buy a 5-year fixed deposit this morning, and let's just for argument's sake say it's 5%, and you lock in a 5% fixed rate with a bank for 5 years, you know that you've put down 100 Rand, and at the end of 5 years, you're going to have 125 Rand. In other words, on your 100 Rand, you've got 5% or 5 Rand a year, and at the end, you're going to have 125 Rand. And that obviously assumes you haven't reinvested the interest. If interest rates later today go to 6%, obviously, if you'd waited a few hours, you would have been better off. So how much worse are you better off, or how much better off would you be if you'd waited? Well, 6% for 5 years is 30 Rand. So in other words, 6 Rand a year gives you 30 Rand of interest. And you'll see the difference between fixed deposit 1 and fixed deposit 2 is 5 Rand. So if you had to go back to the bank in the afternoon after you'd locked in 5% in the morning and the rates are now 6%, they would say, sorry, unfortunately you locked in 5%. And that you're going to get 5 Rand less from that fixed deposit. So if you want to cancel it now, unfortunately, you're going to have to pay in 5 Rand, or you're going to lose 5 Rand of capital. Importantly, you haven't actually lost anything. If you held on to that fixed deposit, you're still going to get your 5 Rand a year, and you're still going to get your money back. It's just a short-term opportunity cost. So if you were going to value fixed deposit number 1 later in the afternoon, you would value it for 5 Rand less or 5% less. And that's really what happens with the bonds that we see in the market. I go and buy a 20-year bond at 11%. I go and buy a 5-year bond at 7%. And I know if I hold those through to maturity, that the capital will be repaid and the interest will be repaid. The big question I've always got to ask is, are those yields high enough? And as I've shown a little while ago, is the yields right now in South Africa are very, very high. So you're not going to lose anything if you hold to maturity, as long as we've invested in or lent the money to good companies or good entities. And what you'll also notice is that interest rates going up are bad if you've fixed your interest rates or you've bought a bond. But importantly, it's very good for bonds if interest rates go down. And this is why I'm suggesting as well in South Africa, if we can lock in yields of 9, 10% and higher, when cash rates are down at 3, or will probably be down at 3 over the next few months, and inflation is down at 3, that is a bit of a dream come true for investors. So whether you're 25 or 85, if you can lock in an inflation plus 6, 7, 8 return out of effectively a long-dated fixed deposit, that's actually better than the stock market does over time. The best performing stock market over the last 130 years was the South African stock market, and we did inflation plus 7. The next best was America on inflation plus 5.5. So if we've got our fixed rate, lower risk investments giving us closer to inflation plus 8, they're not without risk. We are taking some risk, but they're significantly less risky than the risk we would take by investing in buying shares of companies. So what we do in our flexible income fund, and this is again mainly for investors that, because bonds, the coupons that they pay are taxable, this really suits investors that are sitting in a retirement annuity, a living annuity, your preservation fund, your company provident fund, your company pension fund, or if you're not too concerned about earning interest. I go out there and we invest. We've got about 5 billion rand in this fund, and we invest on behalf of our investors across about 40 or 50 different types of bonds and interest rate investments. And I just try and generate the highest rand return possible. And we've been able to quite consistently do that over time. Here you can see over the last 5 years to the 1st of July, we were able to generate just under 10% a year. So it was about 9.6% per year, which was significantly better than cash. It was just under about 3.5% better than cash, and a couple of percent better than the bonds as well. So about 3% better than bonds. Importantly, equities only did about 3%. So the stock market actually didn't do very well over the last 5 years, and the local your local fund managers, your equity fund managers in South Africa only did about 0.3%. So we beat the local equity fund managers sadly and embarrassingly by about 9.3% a year over the last 5 years. And if you compound that, it's a very, very large difference. And importantly, property, unfortunately, over the last 5 years, you're actually down about 50%, including the distributions that you've received. Importantly as well, and this just shows what I was saying earlier, so the bonds for us, even though we've lived through the 2 worst sell-offs in the history of our bond market, we've still been able to generate a decent return, not because bonds have been the latest hot thing to buy. It's literally because they've delivered what they said they were going to do. We've been yielding about between 9 and 11% over the last 5 years, and that's effectively what's happened. We've, in a very boring type fashion, there has been some capital volatility, but typically you can see the falls and moves in capital has been much lower than the normal bonds, which is the government bonds, because we've been buying a lot of the corporate type bonds as well. It's done obviously better than cash and inflation, and then much less volatile than the stock market and property as well. And this is just another way of showing that from a risk perspective. So we're sitting in our flexible income fund with a yield of about 9.3% at the moment, and that's sitting with quite a lot of money in cash. I'm sitting with about 20% of the fund in liquid and cash assets. That I'm very cautiously sitting and watching what's happening in South Africa. I don't believe for a moment that we're out of the woods from an economic perspective, and I'm actually steadily investing into more and more of the longer dated bonds. So even though our yield is about 9% at the moment, the fixed rate bonds I hold in the portfolio are at about 11, and then the corporate floating rate bonds, which are Standard Bank, ABSA, First Rand, Nedbank, etc., are yielding us a bit lower than that, and our overall yield comes at about 9.3%. So really, we're going at about 40 in 120 zone from a risk perspective at the moment. It's a very cautious type fund. We do see some capital volatility, but over time, with a yield of around 9%, over the next 5 years, effectively, that's the kind of return we should expect from this kind of investment. Potentially a little bit higher if we're able to buy some of these bonds at higher yields. But that in an environment where cash rates are going to be closer to 3, maybe 4 if you're lucky, it's a very good, dependable type return. Now, a lot of investors ask me, well, gee, you're not painting a very positive picture for other asset classes. How should I be invested? And this is the Sasfin Balance Fund, which I manage. And we have predominantly pension fund investors invested in this fund. And we sit at the moment with about 15% to the local stock market. And this is for aggressive long-term investors, pension fund investors that are investing for 20, 30, 40 years. And we do still hold some stock market exposure where we believe it's going to add value. And we sit with about 20% in the offshore investments, in almost entirely in the stock market, and about 15% in local equities. Most of our equivalent peers in this space, the other asset managers in the country, sit with closer to 40% in local equities and then a bit more offshore. We've favored a lot of the lower risk investment like bonds and cash, and you can see here between bonds and cash, we're about effectively over 60% invested into bonds and cash and locally. And that stood us in very good stead through the coronavirus type sell-off. But more importantly, as I've shown you, the expected return from those kind of assets are still likely to give us very high returns going forward. And importantly, if things go wrong from an economic perspective, we'll probably a really bad 12-month return would probably be closer to about 6%, which will probably be about twice cash. And in a good year, we'll probably do closer to about 10 or 11 or a little bit more. But really a very consistent type range of returns. But it is unlikely over a 12-month period that we'll be showing negative returns, because we haven't done through the coronavirus 12-month period now, and we haven't done it through even after Nenegate. And we were, if you'd invested with us just before Nenegate with a massive sell-off in the bonds, 12 months later, you would have been up 9%. Now, if for the investors, however, though, that aren't interested in any capital volatility and are looking for a much smoother return and are much more sensitive from a tax perspective, this is where our optimal income fund is a good alternative. And really, this is an alternative to cash and income type investments. And really, we're providing at the moment a returns very similar to cash, but after tax. So investors earn dividends. The yield is roughly it's been dropping with interest rates, so it's roughly around 4% at the moment for most of the investors. Larger investors do earn a slightly higher yield, but effectively a very liquid, you've got worst case 48 hours in terms of investing your money. We have a lot of corporate investors. Sasfin Bank, as an example, actually invests in this kind of fund, which is able to give them a much better return after tax. And it's a very simple type fund. And here you can see if you compare this to the equivalent of from a cash perspective, so if because there is very little tax in the investment, if we gross that up, you can see we've been able to outperform the equivalent of a cash by about 7% since inception. Similarly, this is on an after-tax basis. You can see if for a corporate who pays 28% tax, still able to outperform quite consistently with a very smooth return. And then for a private individual or a trust that pays 45% tax, you can see that gap is significantly wider. So a much more simple investment. The types of credits in that we've got here is a lot of what we actually do here is we buy a lot of foreign bank type investments, or almost like bond type investments, debt investments. So the credit risks here are the likes of Barclays, UBS, Goldman Sachs, etc. So really this is quite a good example where we're able to lend money to a lot of the foreign type companies on a very low risk type basis, and you don't have as much of the South African type risk. But really it's quite a simple investment that allows investors at the moment. So on a corporate cash deposit at the moment, you would probably get about 3.6%. Some of your money markets are a bit higher, but their interest rates will come down. But then you have to pay tax on that. And with this kind of investment, we're sitting at about 4% after tax is the yield at the moment. And he had just some examples illustrating that. And this was just a month or so ago when the yield was a little bit higher. And you can see for a corporate, you're typically outperforming by about 1.8% a cash type deposit. And then for individuals, about 2% per year. So in this low interest rate environment, an extra percent counts a lot. An extra 2% counts an enormous amount. In the investment world, if a fund manager could give you a 2% above their benchmark every year, you would pay them a lot of money. And in a cash type environment, if we can provide you an extra 1 or 2% than you would normally get on an after-tax basis, it's a very, very powerful thing. So the yields at the end of the day are and this just gives you an example of the kind of names that we've got in the portfolio. So everything from the global banks and again, this is a rand investment. It's a local investment, but we're able to remove a lot of the risk that we face from South African companies. So really, at the end of the day, I'm happy to take some questions from here. I haven't really been able to look at the chat room, but the kind of world that we live in at the moment is a lower for longer interest rate environment. We're expecting global interest rates to remain low for many, many years. There are a couple of reasons for that. One is the economic outlook is poor, and secondly, there's just these are mature, developed market countries like Europe, America, Japan, etc., where there are more old people than young people, which means economic growth is going to continue. Those countries are effectively in retirement, and in retirement you spend more than you earn. And that is going to result in lower growth expectations for many, many years for most of those countries. It's not a drama, it's not a catastrophe, it's just the nature of retirement. And in that environment, globally, interest rates, the pressure is going to be to keep them lower. And for us as investors, we need to look for yield where we can get it. And we need to moderate our return expectations from the stock market. If interest rates are 0 or 1, 5% from equities is a good return. But if I can get 9 or 10 or 11 out of fixed rate returns in South Africa, I'm very happy to do that. I still keep my global exposure from an equity perspective, because if the rand appreciates, we benefit from that. But from a local perspective, I strongly believe that whether you're in a pension fund or whether it's your personal money, your money that's in South Africa, you should have a lot more in the lower risk investments, which are giving us better returns, to be honest, than the higher risk investments.
I know you did touch on this earlier, but we just have a question here around the downgrade to sub-investment grade of South Africa by the ratings agencies. Has sort of come and gone, and it seemed to just sort of be a non-event. But I mean, what does this mean for South Africa and for fixed investment going forward?
Yeah, so the reason why our interest rates, our bond yields, in other words, the rates we borrow at used to be low 12, 14 years ago, was because the South African economy was in much better shape. We had under Trevor Manuel, we had a current account surplus and a fiscal surplus. In other words, we weren't spending as much money. And like any, if you go to a bank and you apply for a home loan or a loan, and your expenditure is greater than your income, they're going to lend to you at prime plus 4. If you're a good borrower and you've got good income, they're going to lend to you at prime minus 2. And really what's happened with South Africa is that as we've got a bit reckless with our spending over time, or we haven't spent the money well, the foreign investors are demanding a higher interest rate from us all the time. And what's happened here is that where we used to be borrowing at 6.5, we're now borrowing at 10. And that's the equivalent of, from prime minus 2 to prime plus 2. And if your home loan went from prime minus 2 to prime plus 2, it creates a problem for you, because now all of a sudden a lot of your money gets spent on interest payments. Now, the downgrade is exactly that. You've been moved from prime minus 2 to prime plus 2. You moved in from the A team to the B team to the C team, if I can give you a sporting analogy. You're still playing sports. You're just borrowing at a higher rate. Now, the question is, and what the market does is they factor in, and because the bond investors from all over the world are very happy to lend money to us to buy our bonds, but when there's more risk, they're demanding more return. And that's effectively what's happened with our bond market. But that gets factored in very, very quickly. And as I showed you with Brazil, with Russia, I can show you all the other examples, is that the sell-off, in other words, the interest rate spike that we see happens in advance of the downgrade. And then once the downgrade happens, you're forced to fix things a bit, and you're forced to reduce your spending. You're forced to fight with your trade unions, like we're doing at the moment, about not giving them higher wage increases. All of those things would be seen as positives for foreign investors. And until we get some resolution on that, I think our bond yields will stay quite high. And really, that's giving us an opportunity. And again, I stress a bond is like a fixed deposit. It's not much more complex than that. If you can lock in high rates where they are right now, it's more than factoring in the noise around the downgrade and the problems in South Africa. I've been looking already this morning at, getting some yields into the fund around 1180. on government bonds. And the government, it's important to understand that a government is like a company that raises money from tax revenue, but it can very easily increase revenue, and it can very easily print more money to service the bonds. So in a South African economy, if we did get into more trouble, and even if we started nearing troubles where we had to go to the IMF for bailouts and the likes, the bonds are actually almost the safest place to be in many respects, where stock market in that environment gets absolutely hammered. Your currency gets absolutely hammered. But your bonds and your lending money in the local environment, those are still the safer place to be. So normally when your economic outlook is poor, you want to stay away from the stock market because companies are going to struggle, and you want to fix your rates where you can by buying the bonds. So that's why I give the example of buying Standard Bank shares right now are much, much, much riskier than buying a bond or a fixed deposit from Standard Bank. But arguably, the kind of return that I'm going to get from the bonds is good. It's an excellent return. And if I can get it around 9-10%, then I'm very, very happy. The shares might go up, but they could also fall significantly more. I don't know if that answers the question, Errol.
No, I think so. I think there was another question here, which I think is a sort of a close follow-on to this, and or not onto the question, but sort of what you were talking about. I mean, the South African government is increasing its borrowing quite significantly at the moment, and we're seeing this coming through in the weekly auctions. How much appetite is there for this increase in borrowing, and what does this mean for yields and current positions going forward?
So the South African government borrows about 6.6 billion rand a week at the moment. Now that sounds crazy and would scare everyone, I'm sure, but the American government actually borrows over R1 trillion a week. A trillion, a lot more than a trillion. It's actually about $1.5 trillion. Now, let's just put it in rand terms. It sounds a bit scarier. So governments don't have money; they borrow money, and then they service those loans with the income that comes in. Now, the challenge we've got to South Africa is that we are borrowing more and more, and we're using that money to service a lot of our existing loans. Now, those are every week. In fact, that's what happened at 11 o'clock today. We had a government auction. An auction basically means is the government needed to borrow 6.6 billion rand, and it went to the market. Now it was not a good auction. It was actually a bad one. And the bonds, there were about 2 times as much demand, twice as much demand for the bonds as they actually issued. So there was 2 times as many bids for the bonds, in other words, to borrow the money, as there were bonds on offer. A few weeks ago, it was significantly more. And what will happen is that if the foreign investors and the local investors as well don't think that the yield that they're getting is high enough, then they'll walk away. And what you'll then find is that our cost of borrowing goes up more and more and more. Now, the challenge we've got, though, is that where the yields that we're borrowing on our longer dated bonds are, let's say 11.8 this morning, on our shorter dated treasury bills, it's effectively at like 3.6, 3.75. So government is able to borrow in the 5 and 10 year space at much lower yields than they are in the longer dated. And that's why I see the opportunity by buying those longer dated bonds, because at the end of the day, foreigners are still looking at that and going, wow, 11.5, as soon as South Africa, the dust settles there, we're going to, 11.5% for us is a fantastic return, and we'll be coming back there. So as investors, we've always got to assess and say, how much of the bad news is already in the price? And that's why we're looking at these bonds at the moment and saying, wow, they're really attractive. We're not diving in with both feet. We still are very cautiously keeping some cash back to just in case there is a further sell-off. But I'm pretty confident that over the next 5, 10, 15, 20 years, that these kinds of investments are the ones that are going to be the safer place to be. And I stress that again, that if things do get worse in South Africa, the place you don't want to be is any local company owning their shares. Same with the local banks, property, retailers, etc. If it gets worse, it might even improve slightly. But if it gets worse, things get bad, that's where you get hurt. And the currency is likely to weaken quite significantly. So that's why when I'm managing pension fund type portfolios, I do still have quite a strong offshore exposure. because we even saw it during the coronavirus sell-off. The stock market fell 30%, but our currency lost 30%. So investors were almost flat in rands. And we've seen in the past, if you go back to when Russia orchestrated their debt default in the 90s, in 1998, the ruble went from 5 to the dollar to 30 to the dollar. Now, a lot of the bad news, I think, has already happened to our currency in this sort of environment. But if things do get worse, you're likely to see it play out in currency and in the riskier assets, where your safer assets are likely to still be relatively secure. So a bad scenario for us in flexible income fund from here over 12 months is probably about 6%, as I've mentioned, over a 12-month period, because we're earning about 9%. And if the capital had to drop, even if it's temporarily, we still think we can get close to about twice the cash return. So that's the bad scenario. And then the good scenario, if the foreigners come and buy our bonds, we could see some nice shorter-term capital gains. But at the end of the day, this is not about trying to trade and make profits. This is just pretty consistent income type returns. And on a 12-month basis, you look back and you've just pretty much earned what the instruments are paying in the fund. So it's basically like a big portfolio of fixed deposits.
No, thank you, Philip, and also, a very important point. We're focusing today on income and very much on local income, but as a house, we very much continue to have a message of being global investors, diversified globally, and it's the way that we've approached investments for a very long time as Sasfin, and for exactly these reasons that Philip is articulating here today. Philip, I just also want to touch on one other thing. We had a question here around capital risk, saying that investing in these instruments is not risk-free. There is capital volatility in these instruments. Obviously, a deposit with a bank, provided that the bank doesn't default, your capital to an extent is static. But maybe just elaborate a little bit on the different risk profiles across these instruments or funds at a very high level, where there could be capital volatility.
Yeah, that example I gave on the bonds earlier, by buying a fixed deposit in the morning and then in the afternoon, is exactly the reason why the value jumps around. The instrument hasn't changed. The cash flow is still going to come through. It's just that it's relatively less attractive. I often joke and say, if my house was valued every day, the bank would never lend me money to buy it, because the value should change. Because we value the bonds every day, and it's all about whether you can get a slightly better rate or a slightly lower rate, the capital does move around. But very importantly, as I showed on those examples, when the instrument matures, if you hold it for a number of years, the capital comes back to you. So we can have, during coronavirus, we had a huge drop in capital, when for us it was a couple of percent down. It wasn't anything like the stock market. But then a lot of that starts coming back to you. And when you're earning 9, 10, 11%, pretty much that income is going to be ticking through, even though the capital has jumped around. So that's why I say, if you look at it over a 12-month period, a lot of that capital volatility noise disappears. And the challenge with the stock market is that your capital never matures. So when you need to sell it, you need to sell it for what it's worth, where an instrument that matures is very, very different. I see a question on the group around RAs and the likes, and this is a perfect sort of investment. Our fund, this flexible income fund, or even our other funds, are available on most of the investment platforms. Sasfin does offer an RA type administration for clients as well. But most of my investors are company pension funds, and I must stress that, this is a few years ago, if you asked me how am I going to get you inflation plus 6, I thought, I'm going to have to invest in the stock market, and then I might or might not get it. Where now, at least we're able to lock in those kind of returns for clients that don't want, who need an income but can't afford to take the high risk of equities. In many respects, it's a bit of a dream come true.
Thanks, Philip. Yes, just to reiterate, the Sasfin Wealth Investment Platform does offer RAs and other wrappers which you can speak to your relationship manager with. I think, Phil, we've probably got time for sort of one last question. There was just a question around our opinion on listed pref shares at the moment as an income play.
Yeah, it's an interesting one. So, the preference shares are a good example of an instrument that doesn't mature. So They were issued at nice yields back in 2006, but it's a bit like a bond. A preference share is a bit like a bond. It's linked to equity, so it's a bit riskier. But because it never matures, you never know your value you're going to get is the value you sell it at. So I think the yield on the preference shares, because it's a dividend type yield, it is a little bit more tax efficient for certain investors. But if I have a look at like Standard Bank as an example again, I gave you the example of I can get about 4.5% on a 1-year fixed deposit. I can get about 5.5% to 6% on a 5-year kind of deposit with a Standard Bank or a bond. And the preference shares, and then some of the other bonds that I hold, other Standard Bank bonds, are giving me closer to about 9%. Now, if the preference share is giving me 9% and it never matures, I'm never certain I'm going to get my money back. And if something did go wrong with the likes of a Standard Bank, I gave the example of African Bank. If something did go wrong, you're going to take you're not protected from you're one of the last in line to get your money back. So a preference share is riskier it's less risky than this buying shares in a company, but it is the second most risky thing you can buy from a company. And the next thing comes there are the different types of bonds. So if tax is not an issue and the yield on the preference share is the same as the bond, then it's an absolute no-brainer to buy the bond because it matures, it's less risky, etc., etc. The challenge you've got, I suppose, is a lot of investors in the preference shares have held them for quite a long time. But like with any investment, you've got to have a look and say, well, if interest rates are going to stay low for longer, then the yield you're going to get from that preference share is probably the yield it's giving. And if interest rates come down again, you're going to earn, if interest rates come down 50 basis points, the way those preference shares are structured, you will earn about 0.5% less or more. So it's really a case of, sometimes I think you need to look at the risk and the return, and I can't really advise anyone because I don't know what they've been invested in. But myself, I could invest in preference shares in the funds I have, but I don't hold absolutely any because the liquidity is not good and the risk is much higher than the bonds that I buy. Much higher.
Thank you very much, Philip. I think we're almost out of time, so that's really what we have time for today in terms of questions. So thank you to all the participants for joining us and for your questions. And please note that our webinars and a host of other content is updated on the Sasfin Content Hub on a daily basis, which you can find at sasfin.com.